Hey, what's going on, everybody? My name is Ryan, and I'm a CPA. Thanks for joining me today. Today, I'm going to be talking about the 5 best ways that you, as a business, can minimize your taxes. And don't worry, this is not going to be any of that crazy shit you see on TikTok that is like semi-legal or maybe not even a little legal. These are actually legit things that you can do, and I'll go through all of them in slight detail here right now. All right, so if you're an S-Corp owner, the one thing you want to think about and really review is your payroll. If you are an owner of an S-Corp, as the owner, an active owner, you are required to pay yourself a reasonable salary, right? However, a lot of things I've come across in my travels as a CPA firm owner is that sometimes S-Corp owners pay themselves too high of a salary. Now, I don't mean too high as in like, oh, that's gonna raise red flags. I'm just saying too high as in they don't need to be paying themselves that much. They could get away with paying themselves less and still fall within reasonable salary range. And so what I want you to do is just review your salary if you're an S-Corp owner and just see if it's too high versus what industry average is in your profession, in your area. If it's too high and if you think you can bring it down a bit and it still be reasonable, then that could actually save you a lot of money in taxes. How does it do that? Well, when you lower your salary, you lower the amount that you pay to Social Security and Medicare tax. And so if you can at least stay within reasonable salary range and lower your salary, that's one pretty big area where you can save on taxes. Now, reasonable salary. That's a loaded term. There's no specific guidance on it. But so I typically recommend you talk with a professional on this, what's reasonable and what you can safely do without being in hot trouble with the IRS. The next thing I want to talk about is depreciation. So if you're unfamiliar with depreciation, it is what happens when you buy a big asset, or also known as a capital asset, okay? Like a car or a big piece of equipment or a house, those kinds of things are capital assets. Most capital assets qualify for something called bonus depreciation or Section 179 depreciation. Normally, if you buy a capital asset, it has to be depreciated over time, either 3, 5, 7 years, something like that. And each of those years, you take a small chunk of the cost of the asset as your expense. But if your asset qualifies for bonus depreciation or Section 179 depreciation, what you're basically doing is accelerating the amount of expense you can take and taking it more upfront. You have to be careful here because if you then plan on selling the assets, then you have to recapture whatever you depreciated as income. So this typically is more of a benefit on assets that you plan on keeping long term. If you're going to be buying something and then maybe selling it in a year or two, it might not be worth doing bonus depreciation, although I still would recommend you consulting with a professional on that because usually the depreciation or recapture tax it can be less than the actual income tax you would have paid on the front end. So something to consider. Most small businesses with most assets would qualify for bonus depreciation. All right, the next obvious thing is retirement. It's such a boring thing, such a boring strategy, but it's solid, right? And so if you're a business owner, and let's say you are the only one in your business, no employees, no W-2 employees, it's just you, it's really easy to set up something like a SEP IRA or my favorites, the solo 401k. A solo 401k is great because you have a pretty high contribution limit. It's essentially you have a contribution limit from the employer contributions that can be made, and you have a contribution limit on the employee portion that could be made. And that's why I like the solo 401k more than the SEP IRA, especially for S-Corp owners, because part of your contribution limits is based on your W-2 salary as an S-Corp owner. So having a solo 401k and making contributions to that retirement plan results in a tax deduction for the current year. And yeah, you do end up locking money away until you retire. Yes, so that's something you have to weigh against whether or not you need the cash now versus later, but it's never a bad idea to plan for retirement down the road, whatever that looks like, So 401k, great. Any contributions made to a 401k or a traditional IRA or SEP IRA, those contributions are tax deductible at the time they're made, as long as they're qualified contributions. If you are more into Roths, which I love as well, just remember that contributions to a Roth IRA are not deductible. However, the benefit of the Roth is, even though they're not deductible on the front end, any distributions you take on the back end when you retire are also not taxable, which is a huge benefit there. Now, if you have employees or other people in your company, other owners, other partners, or whatever, you can't use a solo 401k because that's only for you. It's only valid if you are the only person working in your company. If you have other partners or employees, then you might have to look into traditional 401ks or simple IRAs, something that's a little more complex than just a one-man retirement fund, but still something to consider. And also, don't forget, including retirement benefits as part of employment benefits, it just not only helps you get a tax deduction, it helps you keep good people just by way of, hey, here's a little extra money I'm going to contribute to your retirement, and it's an added benefit for them and makes them want to stay with you longer. All right, the fourth thing, self-employed health insurance tax deduction. So self-employed health insurance, if you are a sole owner LLC, super easy to take. You just take whatever health insurance you pay, health insurance premiums you pay personally, and you report it as a deduction on the schedule, I believe Schedule 1 of your tax return. If you are a partnership or S corporation, the reporting on that is a little more complicated, so you just have to make sure it's done correctly at the corporate level. And then after it's done correctly on the corporate level, you can take the deduction as a self-employed health insurance deduction at the personal level. So this is something that's really easy to do. There's no income limits. There's no medical expense floor like you would have for the itemized deduction with medical expenses. There's no real major limits like that on the self-employed health insurance deduction. So if you're an owner of an S Corp or partnership, just make sure it gets reported correctly on W-2s if applicable and on the K-1s if applicable before you take it as a deduction on your personal tax return. But if you're paying for health insurance for the family personally and it's not ran through your spouse's employer or anything like that, if you're paying for it out of pocket, this could be a pretty easy way to get a pretty big tax deduction on your tax return. And the last thing I want to talk about is employing family members. Sometimes older children, sometimes people in your family that just need help. And notice how I said employing family members and not just putting them on payroll. Those are two separate things, okay? You'll see a lot of videos on social media talking about putting your kids on payroll or putting your brother who has no job on payroll. But really the important distinction here is we want to make sure that they have an actual job to do within your company in order to justify the payment to them, okay? There's one thing to put somebody on payroll. You can put your 2-year-old on payroll and pay them a salary. Sure, whatever. That doesn't seem really legit to me. But it's another thing to, let's say, hire your 10-year-old son or daughter to organize your office once a month, twice a month, whatever. Come to your office, tidy up, organize, file paperwork, pay them a reasonable wage that's not overpayments, and that way you've employed them and you have paid them some money. And the reason that this is it could be a good deduction here is because if you pay your kid, let's say it's your kid who's under 18, less than the standard deduction, then they don't have an income tax filing requirement. And the other benefit is you and your business get a tax deduction for their wage expense, if that makes sense. So as long as you pay them under the standard deduction and as long as they have an actual job at your company, you can employ them, pay them a wage, you get a tax deduction. They don't have a tax filing or payment requirement because they're under the tax deduction, and it's a good thing to do for business. And it kind of will teach them, the benefits of having a work discipline and earning money. You can kind of roll that into parenting if you're into that crap. I definitely am, but my kids are not old enough for this yet. So, when they get old enough, maybe I'll find something for them to do to earn some money, to see what it's like to have a discipline at work, and you kind of get that started early for them. All right, that's all I got for today. Thanks for joining me. Again, my name is Ryan. It's been a while since I made a video, hasn't it? But it's good to be back. Hope you enjoyed this. Please do share this video to somebody who you might think will find it helpful. And also, if you're new here, please consider subscribing. I'd really appreciate that. All right, so y'all take care for now. I'll see you next time.
They act like they ain't know. Guess I gotta hit them with an update. Okay. I been getting to it when I'm up late. Hit it when you went the front gate. They act like they ain't know. Hold up. Guess I gotta hit them with the update. Really with it, I ain't got a pump fake. Killer flow and hit them with the one take. Act like they ain't know. Guess I gotta hit them with the update. Okay. I been getting to